Good evening to one and all present here. I welcome all the members. One second. I welcome all the members for the 6th day meeting on comprehensive course on GS. And I welcome our today's speaker, Vaitheeswaran sir, all along from Chennai. And we thank you for accepting our invite to share your expertise knowledge with our members, sir. Thank you. Thanks a lot, sir. Today, sir will be discussing on the topic works contract and construction services related issue. Regarding the queries, you can type the questions in the chat box. Sir will be answering for all your queries at the end of the session. And one more point is we'll be sharing all the recorded version of all the 6 days course on GST program. So all the link will be sent to your mail ID so that you can refer in case if you have any doubts. Vaitheeswaran sir is well known among all of us, but still let me give a brief introduction about him. Mr. Vaitheeswaran sir obtained a law degree from the Madras Law College and enrolled as an advocate in 1990. He also obtained a graduate CWA from the Institute of Cost and Works at Accountants of India, and he has completed the ACS from the Institute of Company Secretaries of India. He joined the offices of Mrs. Subbaraya Iyer Padmanabhan and Ramamani in the year 1990, and he became a partner in the year 1998. He started his own firm in the year 2000 and currently operates with offices at Chennai, Bangalore, and New Delhi. He has 30 years of experience in the advisory capacity as well as the through appearance before appellate authorities, tribunals, and courts in matters arising under domestic and international tax laws, excise and customs, service tax, VAT, CST, GST, PEMA, RERA, company law, and IBC. He is considered as a specialist in tax and legal matters with in-depth knowledge of the business and tax laws. He has addressed hundreds of seminars and conferences on law and taxation across the country and abroad, and is the most sought after legal professional in GST and business restructuring matters. He is an expert in real estate contracts and has recently forayed into technology, law, and artificial intelligence. He advises clients across the country on various verticals such as manufacturing sectors, retails, healthcare, food and hospitality, gems and jewelry, information technology, societies and clubs, logistics, banking, and almost all the areas. He also advises various associations and Chamber of Commerce. He wrote the first comprehensive book, VAT in India, when VAT was introduced in the year 2005, and he has also authored books on Selvat credit, books for the students appearing in the CA final examinations. He has written hundreds of articles covering a variety of issues in tax, corporate laws, constitutional law, and general laws in both print and digital media. His new book, Taxation of the Digital Economy, covering international tax and indirect tax aspects, has just been released both in the print and e-version. And he is the chairman of the expert committee on GST, Madras Chamber of Commerce and Industry, and also a member of the General Committee of the Madras Chamber. He is presently the member of the Finance and Taxation Committee, CII, Southern Region, and Vice President of the Revenue Bar Association. He is also a member of the SIC, Indo-American Chamber of Commerce. He is a recipient of Vocational Excellence Award from the Rotary Club of Madras Southwest. He is actively involved in various social causes through music and also forays into humor writing. Sir, with this brief introduction, I welcome once again Vaitheeswaran sir. Over to you, sir.
Good evening, friends, and it is nice that you're able to connect through this virtual mode. Though whatever I'm hearing about Madurai is not so nice. We at Chennai, every day we have crossed multiple numbers, and now we are 2,000 plus per day in Chennai, positive cases. And whatever lessons we have learned, I hope Madurai also does not repeat those mistakes which many did. If I can use this platform to extend this opportunity to help Madurai to fight the battle better, the simple solution is, if you're required to stay home, please stay home. Work is not important. Work is just not important. Yes, money will come, money will go. There will be some problems, but you can always earn back. But if you get into problems of health, and you will pass on the problem to somebody else. Many will not suffer themselves, but they pass on to others. And that is a real challenge. So through this platform, I will extend a request that across your friends and circles and clients or whatever associates and yourselves, wherever the law is that you have to stay at home, you please stay at home, and that should be the approach. With that, let me go into the slides. Straight away, the first slide, madam, you would kindly help me on that.
Yes, sir. Yes, sir. Is it visible, sir? Right?
Yeah.
Yes.
So basically, if you look at the background of real estate segment, the title is wrong because it was an old title. I didn't modify the title. The title today our discussion is only GST and not RERA IPs. So typically before 1/4/2019, just like before COVID, after COVID, real estate has become before 19 and after 19. So before 1/4/19, it was a situation where GST was paid at 18% on construction agreement. So typically what will happen is there will be a two document. Construction agreement, the developer will pay 18%. Sale of undivided share of land, there is no GST because the sale of immobile property. This is one method. The other method was, even though they executed two documents, they followed what is called an effective rate of 12% by calling it as construction of complex or construction services. And they aggregated both the land and the construction consideration. And then, of course, in terms of affordable housing, the effective rate was 8%. When it comes to villa, two models were there. First, you will sell the plot of land and then enter into a contract for construction and charge 18% for construction. Or alternatively, you will combine both together, and the total consideration you will charge 12% effectively. Next. And the practices before 1/4/2019 was simple. If in case CC happens, completion certificate is issued. In some parts of the country, completion certificate is not issued by the authority, but completion certificate can be issued by certain other agencies as specified in the Act. And if completion certificate is issued or first occupation of the property takes place, then after that stage, if you get a customer, fresh consideration, fresh transaction, no GST. And of course, in some cases, people said, okay, I've got my CC, I will have to reverse my ITC. Then there were some people who said that, no, why should I reverse my ITC just because I get CC? I'm not selling anything. Just a CC is an event. And there are some judgments which says there is no necessity to reverse. I will not reverse. Then there were this question of landowners, whether landowners should charge GST on the customer or not. Then there was this dispute as to whether developer should charge GST on the landowner share when he gives area sharing. Then there were a lot of disputes on whether developer should charge GST on such a transaction based on distance. And then ultimately the debate was whether development rights are liable to GST. So before 1/4/2019, there are a lot of complex issues around this topic. I'm not saying that those issues got sorted after 1/4/2019, but I'm just highlighting the nature of disputes. Next. So what was the massive change in GST law from 1/4/19? 6 CGST rate notifications, 6 IGST rate notifications, and the entire rules were amended. There were removal of difficulty orders issued, and 68 FAQs were issued. This is like this. I remember my one of my seniors saying this. If somebody makes a statement and then follows it up with another line by saying, in other words, that means the speaker is also doubtful as to whether he has conveyed the meaning properly. That's why he uses the word in other words. So when the law is supposed to be simple and they change the law, what was the necessity for 68 FAQs on the subject? That means that much of confusion was already there. Now this confusion is even more compounded by the fact that the FAQ preamble says the answers to the FAQs have been given in a simple language for guidance and easy understanding of all stakeholders in the real estate sector. They do not have force of law. In case of conflict, gazette notification which have legal force shall have precedence. Gazette notification புரியலன்னு சொல்லி தான் FAQ கொடுக்குறாங்க. FAQ டவுட் வந்தா திருப்பி gazette notification போனா அந்த FAQ வேண்டாம். Interesting way of looking at this. Next. So let me split the relevant entries for construction. So this entry 3IF is the popular entry that is there everywhere. So what am I doing? I'm constructing a complex or a building or a civil structure or part thereof. It can even cover commercial apartments, shops, offices, godowns, or it can be a residential apartments in an ongoing project. In that case, the GST rate is actually 18%. ITC is available, and effective there is a 1/3 deduction towards the land value, and therefore industry calls it as a 12% on the total consideration. So if it is a commercial apartment complex or it is a residential project but an ongoing project, and it should not be an affordable residential project, then what is the benefit? Your ITC is available, your GST effective rate is 12% because 1/3 reduction is available, and some companies have avoided this. Next. And in case you are doing an ongoing project, but it pertains to a scheme that existed before the amendment, then they said GST will be at 12%, ITC is available, 1/3 reduction towards land. Therefore, this was also effective rate 8% with ITC. Next. So all developers were under a dilemma. Professionals were under a dilemma. Should we go for ongoing project status or should we go for the new rates? Because the new rates was 5% without ITC. See, what is this 5% without ITC? This is an experiment which worked for hotels. When the GST originally came, everybody was unhappy with the rate of tax, specifically in the hotel industry. And consumers were complaining, saying that the rates are very high. So the council thought about it and said that, okay, hotel industry has got tremendous customer interface. So let us understand this business differently. And then they said 5% GST without ITC, on the presumption that the hotel may not have that much of ITC requirements because most of the food and vegetables, etc., are exempt from GST when they buy it. So to some extent, that experiment worked for hotels. So based on that logic, they said, why not we apply to the construction also? Consumers are also a large force. So it's also a consumer-facing industry. Why not bring they thought that by putting 5%, the price of apartments will become cheaper. Because their idea was 5% will be, let us say you're buying a flat for 75 lakhs. So when you're buying a flat for 75 lakhs, 5% on that vis-a-vis the original rate of 12%, 5% is definitely cheaper. They forgot the fact that ITC plays such a big role in construction business. It is 70 to 80% of your construction cost will come from goods and services which have significant GST. 28% GST is there for cement. Then you have so many other materials and subcontractors, etc. So the moment you are not able to take ITC, then your cost goes up. If your cost goes up, you cannot remain with 75 lakhs. You will have to increase the price. So in effect, even though 5% was brought in as a relief for the consumers, it was not a relief for the consumer because the ultimate selling price of the apartment went up because cost went up because of non-availability of ITC. So many of the professionals knew this, auditors knew this, chart accountants knew this, builders knew this. And therefore, the biggest dilemma was, what should we do? Whether we should treat it as an ongoing project and go by the old rate and get the benefit of ITC, or we treat it as we opt for the new rates, whereby we choose voluntarily that I'll go under 5% scheme and I will not avail the ITC. And then there were challenges. There was a single RERA approval for the entire project. There will be 4 towers. Work may yet to commence in respect of 3 towers, while 40% work is complete in respect of 1 tower. Then there were questions as to whether only 1 tower is ongoing. We had the AR rulings on this point also. Then there could be scenarios where the project itself involves only 8 apartments. If it involves less than 8 apartments, RERA itself is not applicable. If it is RERA itself is not applicable, why would I apply the RERA law in reference to ongoing project and excavation work? Then there could be a project which was commenced before 1/5/2017. 1/5/2017 is the date RERA came into force. RERA not applicable if CC has been issued. Now, the dilution of all those things have happened as far as the state laws in real estate is in RERA is concerned. Therefore, whether it is CC or not became a big issue. Next. So what is the effect of exercise of option? I have to exercise in one-time option. And the law said, if you don't exercise that option, you are deemed to be under 5%. That means if you keep quiet, you are under 5%. You have to choose and write and say, I don't want 5%. Mine is an ongoing project. I am meeting the definition of ongoing project. Therefore, I want to retain the old rate. Now, the question that can come is this 3/2019, which brought this 5% category. It says that, look, you can't get ITC. It also says so many things. So my first question would be whether powers are even available under section 9(1). to specify rates. Second question would be, can a rate of tax notification have conditions inbuilt on it? Next. What happens to projects where the option for old rate was not exercised? Can I still file a declaration belatedly? My view, it is possible. Can a substantial benefit be denied for delay if there is a bona fide reason? Obviously not. In fact, there are decisions even in the context of letter being a procedural requirement, and even if I miss the letter by the due date, I can give a subsequent letter because my intention is to take the benefit of that. Next. Next. So now, just go back one slide, please. Can you go back one slide?
Yes, sir. Yes, sir. 1 second. It is issue number 1.
Yeah. So let me first focus on the issue. See, I have not spent much on the earlier slides because most of you know it, and most of you already excised the option and gone for the 5% category. There's no point in talking about ongoing projects because they're all history. So now I'm looking at ideas. The rest of the session will be issues. I will pick up 3 or 4 issues and debate it extensively so that it is advantageous to the members also. My first question is, everybody pays or everybody thinks that we have to pay GST at 5%. If you are a developer, 5% is the category. So land value plus construction, let us say it comes to about 75 lakhs, 5% is my only option. I'm stuck to it for life. I'm bound by this notification. I cannot take any ITC. Whatever GST is charged is my cost. I can't take subcontractor GST credit. Whatever reverse charge I pay, I can sell it's a cost. I have to buy from registered suppliers only. If I don't buy from registered suppliers, I have some problem. 80-20 formula is applicable. If I don't meet the 80-20 formula, I have to pay some GST amount to the government. All this is one route. So I'm now trying to put a contra thought saying that whether 5% is the only option. Next. So let us say a developer pays GST at 18% on the construction consideration. See, Tamil Nadu has got an advantage. The advantage is that under our existing stamp duty structure in Tamil Nadu, the construction agreement is treated as a separate document, which attracts a separate rate of stamp duty. And the sale of undivided share of land is treated as a conveyance and attracts a separate rate of stamp duty. So all builders go through 2 sets of documentation, one called as a construction agreement of an apartment and one for the sale of the undivided share of land relevant to the apartment. Both have separate considerations. So if it is 75 lakhs, let us assume 25 lakhs is for the land and 50 lakhs is for the construction. Now, the developer decides that he will pay 18% on the 50 lakhs being construction consideration. And then he decides that I will take ITC because 18% there is no prohibition, you can avail full ITC. And land anyway is not taxable. Therefore, the 25 lakhs of consideration does not suffer GST. I have the ITC fully enjoyable. Then the customer says, look, whole world is charging 5%. Why are you charging 18%? I may even have the luxury of giving a discount and charge the customer 5% and pay the 13% difference to the government account through my ITC. My ITC will be significant, whereby I can use the ITC to pay. So in my tax returns, I will still show 18, but it is up to me to collect the tax or not to collect the tax from the customer. So I can take 5% alone from the customer, keep the customer happy, and still take the benefit of ITC. There are some developers who are also trying this methodology. Next. Now, why do I justify this, or how do I justify this? Notification 3/99 has amended 11/2017. As all of you know, 11/2017 is the rate of tax notification for services. Now, 11/2017, if you care to read, it will say that it has been issued an exercise of powers under section 9(1), 11(1), 15(5), and 16. 9(1) is the power to notify rate of tax. 11, on the other hand, is the power to notify exemption. 15.5 talks about value to be prescribed, and 16 talks about conditions and notification restrictions to be prescribed. Now, interestingly, the word prescribed has been defined in the CGST Act. Now, whatever those 4 bullets which you read are 9.1 language, 11.1 language, 15.5 language, 16.1 language. Prescribed means prescribed by rules. This is the definition under the Act. So, if anything has to be prescribed through 15.5, it can only be through rules and not through notification. If anything has to be prescribed through 16.1, it can be prescribed only through rules and not through notification. Therefore, when the notification says it has been issued in exercise of powers under 15.5 and 16.1, putting conditions with reference to ITC or putting conditions with reference to value through a notification is impermissible. It is not authorized. Then we are left only with 9.1 and 11.1. 9.1 is the rate of tax. 11.1 is the power to grant exemption. Therefore, one way of reading this would be, since rate of tax cannot put conditions, there can be a concessional rate in the form of an exemption, and that is why they've used the word 11 into it. Therefore, 5% is like a concessional exemption. If 5% is like a concessional exemption and there are conditions along with it, there are a number of decisions right from the earlier excise range saying that a conditional exemption is not binding. Only an absolute exemption is binding. For example, if tomorrow, if today the law says milk is exempt from GST, nobody can charge GST on milk because milk is exempted. But suppose there is a notification that says milk is exempted provided it is in plastic pouches, then it becomes a condition. So only when an exemption notification is married with the condition, it becomes a conditional notification. If it's a conditional notification, somebody can choose to ignore the condition and charge the full rate. This is a settled law. Therefore, when 5% is operating as an exemption notification through a concession and has got 6 or 7 conditions to be fulfilled, a developer is entitled to say, I don't want this conditional notification. I don't want to be bound by this 5% category. I would go to 18% category for my construction consideration. Land will be out of the equation because land is not subject to GST. Next. This is what I've elaborated. Power to notify rates is a simple power and there is no power to specify conditions, restrictions. Power to grant exemption does not confer power to provide a deeming fiction where option is not exercised. Non-availability of ITC can be specified only through section 17.5 and not through a rate notification. 16.1 does not confer power to grant credit. 15.5 requires rules to be firmed and not through a notification. Next. So developers follow WCT category and discharge 18% GST. And then now the question is, what happens because of the entry of works contract being deleted from the notification? Doesn't matter. All other construction services, the residual entry, you can still pay 18% GST under the residual category. And then you can also take the ITC. Next. Next. So as I said earlier, the first issue is I'm of the view that 5% is not the only option. It is open to a developer to examine these provisions in a different light and then take a position that he will charge 18% on construction, avail ITC, and not charge GST on the land portion. Now the second question is, there are people who have already got into the 5% scheme. You have gone into the notification, accepted the notification, and under that notification there are a lot of complex formulas. And in the terms of complex formulas, they ask you to go back in time from July 17 onwards and also to the transitional period and to look at all your credits that you have taken, and they ask you to reverse those credits by a cutoff date. And that cutoff date was 30th June. There was also a form Chalan prescribed in the note through websites to say that through this format you have to pay this amount. Now, can a notification ask you to pay back what you had already availed. Next. So at the 5%, you have requirements saying that you have to pay tax only through electronic cash ledger. You cannot take ITC in respect of supply of goods and services. You have to reverse ITC in respect of what is attributable to construction, where the time of supply is after 1/4/19. 80% of value of inputs and services other than development rights should be from registered suppliers. If there is any shortfall to the rate of issue, tax should be paid voluntarily through RCM. So all these things are there. Next. So multiple questions. Can a rate notification say you should buy only from him? How can a GST rate notification mandate that you should buy only from a registered supplier? Anyway, input tax credit is not available. Whether I buy from a registered supplier or unregistered supplier, it has no impact on me, except for the fact that I will have some savings in terms of cash outflow. For example, I may buy goods from a dealer because he's my neighbor. He's less than 20 lakhs. He's not registered. What is the harm in buying those goods from him? But the law says no, you cannot buy from unregistered suppliers. At least 80% of your procurements must be from registered suppliers. What is the legal sanction for 80/20? And then it talks about a calculation of tax payments on a shortfall at the end of the financial year, and then you have to pay by the 30th of June. Now, my question is this: can you put all this in a rate of tax notification? Does there power even exist in RCM to say that based on shortfall you pay RCM? When section 9(4) is structured in such a manner, it talks about a class and category and not in terms of shortfall. Next. All the calculations for reversal of ITC is based on carpet area. And then you have this definition of carpet area as per RERA. So there could be some element of cost losses also. It's not a major point. You can skip it. Next. So entire ITC from July 2017 to 31/3/19, including transition credit, is the starting point. Interestingly, the same authorities have already issued notices saying that transition credit you cannot take for real estate business because the cement has gone into the pillar, it has become immobile property, therefore we cannot give you credit. Then there is a proceeding before anti-profiting authority who says that no, you have to pass on the credit benefit. Now this notification says withdrawal of vested rights. It says whatever ITC you have availed will have to be withdrawn, and there's redetermination of eligible ITC, and complex formulas exist. Next. Next one.
Yes, sir. Issue number 2. Shall I keep this?
One, just go back to vested rights. I'll complete the point before I go to the next issue.
Is this the right slide, sir?
ಇದಕ್ಕೆ ಮುಂದಿನದಮ್ಮ. So taking away vested rights, asking you to take away your ITC is amounting to taking away your vested rights. So vested rights is a well settled position, and you cannot take away vested rights as per decision of the Supreme Court, saying that you have already availed the benefit of a right, you cannot deny that right. What was availed at that point of time cannot be retested and taken away, and that is how the concept of vested rights was laid on the Supreme Court. So can there be a notification says, even though you might have availed at that point of time, even though when you availed it was correct in law, even though we allowed you to avail the credit at that point of time, now we'll say, because you're going for 5% category, go back to the past and wipe out everything. Now, that is questionable and definitely it can be challenged. Next. 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 See, I think we are having some challenges in terms of this PPT. So what I will do is, you just pick up the issue. I'll speak on that issue. I can anyway share the PPT later point of time. So go back to the earlier slide when the question is issue on land.
Yes, sir. Sure.
One slide. That way the continuity for the audience will also be relevant.
Okay, sir. Want me to move to the next slide, sir?
One slide, mundina slide. So land portharikku, one typical issue is, let us take one business. I am a developer, and as a developer, I gave you the example of 75 lakhs as an apartment total consideration. In the 75 lakhs, it is, let us say 25 lakhs is land and 50 lakhs is construction. Now, if I am under the 5% category, effectively, I would charge 5% on 75 lakhs, whereby the 5% has been effectively taken into account 1/3 towards land value, and that is how 5% has come. Imagine a situation where the land value is very high compared to construction. Let us say a major city where the land value is actually 1 crore, construction is only about 50 lakhs. Now, in this kind of situation, 1.5 crores becomes the total consideration. 1/3 is the deduction towards value of land. Therefore, only 50 lakhs will be given as a reduction towards value of land. Whereas the actual value of land is 1 crore. Therefore, a person might like to say that if I go by the 5% category, I'm forced to go by 1/3 value of land. I don't want that 1/3 value of land. I want actual value of land. Therefore, I'll go for 18% and nil. Second, a person who's in the 5% category says that, yes, I will remain in the 5% category. 1/3 value of land, I don't want. I want actual value of land. His argument would be, there can be no GST on land. If there can be no GST on land, any attempt to put GST on land through a formula is also wrong. Therefore, if you simply say 1/3 as value of land, ignoring the actual real value of land, then that notification is incorrect. I have every right to substitute the actual value of land. Now, this is an interesting argument. This is supported by certain decisions, not necessarily on real estate, but in the customs law, where under the customs law, when you import certain goods, there valuation rules contemplated certain additions. And one of the additions was handling charges. And the law contemplated that handling charges shall be 1% of CIF value. So one of the assessees argued saying that my actual handling charges is much less than 1%. Why should there be a deemed 1% addition? So the Supreme Court said, we will read down the section and said that in case you're able to prove that your actual charges are lower than the deemed figures, you can go for the actual and need not be going by the deemed. So if you apply that logic here, if my actual land value is much more than the 1/3 value that is given, nothing should prevent me from adopting the actual value. Of course, you will have litigation on that, but you have enough arguments to put forth to say that why land cannot be subject to GST. That is the first aspect of land. The second aspect of land is that somebody is engaged in a simple business of plots. So he's buying a massive set of lands, getting necessary approvals, getting the layouts approved, getting them converted into plots. He makes the roads, he makes the levels the grass, levels the ground, puts electric fencing, he puts all kinds of wires, sanitation, water, drainage, pipes, everything, etc. Now, a lot of questions will come up. First question is, how are you dealing with the customer? Some people enter into what is called as a sale of land for, let us say, 50 lakhs, and then a development agreement for 10 lakhs. Now, there is going to be a controversy. The department will contest by saying that development charges are liable to GST. So in some cases, some builders are charging development charges with GST in the context of plots. In some builders are saying that my principal supply is sale of land. My development charge is incidental to the principal supply. Therefore, if the first item is not taxable, the second item is also not taxable, and therefore there is no necessity to pay GST on 60 lakhs. A third category of persons are much more smarter. They say, I will raise a conveyance for 60 lakhs. I will not break it into development charges and sale deed. I'd rather pay stamp duty. So I'll put the entire 60 lakhs as a sale deed value, which includes all the development charges. One for all, sale of immovable property. I paid stamp duty. There is no dispute as far as GST is concerned. So the third option is the safest and conservative option. The first two options will have some kind of challenges. Then comes a typical transaction, what we call as joint development agreement. So what happens in the joint development agreements? Two things happen. The owner of land, let us imagine this, he is about 85 years old and he's got an old ancestral property. If he wants to sell it as a property, nobody is buying, because whoever is buying has to break it down, and only for the land they have to buy, and they don't have that much of money to buy. And he's got quite a number of family members to distribute the money. So what is, he goes to some advisor, and the advisor says, why don't you go for development? Easier, you don't have much of headache, somebody will take care. So the landowner, who is 85 years old, sits into discussions and negotiations with the builder. He checks various developers and enters into an agreement called as joint development agreement. So he enters into a joint development agreement where the developer says, I will demolish this property. I'll apply for construction of a complex. I will build 100 apartments here. Out of the 100, I will give you 60. 40, you permit me to market. I will sell it in the market. So the 60 I will hand over to you. You keep it, you sell it, you do whatever you do. The old man is happy because one, he doesn't have to pay money to construct. Two, he's finding some way of exiting. Three, he is of the view that at some point of time he'll get at least 60 flats. He may distribute amongst his family members, rest he may let it out or sell it out and make some money. So some way, and he also gets a refundable deposit which he can put in FD for some time. So he is happy. Then the developer says, for doing all these things, I need power of attorney. You have to give me power of attorney to apply for all the permissions. You have to give me power of attorney to sell the undivided share of land attributable to 40 apartments to customers. Yes. You have to give me possession of the property. Yes. All done. Now comes the question of GST. The 85-year-old man is confused. His advisor is confused. The friend of the advisor is confused. The great grandchild of the 85-year-old man reads WhatsApp regularly, therefore she is also confused. Everybody gives their own view, and then some of the literature in the market also gives different perspectives. What would be the correct position? So I will split the entire transaction layer by layer so that we spend a little bit of time to understand this transaction. The old man who was owner of 100% of the property is no longer the owner of 100% of the property, because he is giving me rights for 40% of the land. You can sell it to customers. He is not getting any money for it. Instead, he is getting 60% constructed apartments or 60 apartments. So the first question that arises is the owner a client? Is the developer a supplier? If the developer is the supplier, is he providing construction service for the customer being the owner? And therefore, the developer, is he required to charge GST on the construction carried out for the owner? The notification is quite clear. It says you have to take a comparative rate. You have to find out a rate at which the same kind of apartment is sold to another customer at the nearest point of time. Apply that rate for the area that is constructed for the owners and pay GST. My question is, let's understand this transaction in depth. Is there a service being provided by the owner to the by the developer to the owner? Answer is yes. I don't think you can escape that because some construction is being carried out. Is he getting money for that? No. What is he getting? He is getting some other rights. People call it development rights. But we'll come to the development rights a bit later. But he gets a little more than development rights. He gets the right to sell the balance of the 40% of the land. The owner who was a supreme owner of 100% of the land is now a diluted owner of 60% of the land because 40% of the ownership in land is gone. So the notification makes an error when it assumes that the only consideration involved here is development rights. Development right is a right to develop property, but the land is also going as consideration. So if you simply value the development rights, you are not really valuing the transaction. And how do you value development rights? There are no methods for valuation of development rights. You can't simply apply the square feet area. Development rights are not measured in square feet. So let us come back to that valuation part a bit later. But first question is there a service provided by the developer to the owner? For this, you have to refer to the judgment of the Supreme Court in the case of Fakir Chand Gulati. In Fakir Chand Gulati, which was a consumer protection case, the issue that arose was the landowner and the developer got into a fight. The owner said the developer is not complying with the joint development agreement and therefore his rights are affected. He went to consumer court. In the consumer court, the developer argued by saying, we are both joint venture partners. We are not a consumer service provider. Consumer relationship does not exist between us. Then the court said, none of your joint development agreement clauses indicate that you are partners. You are saying that you will have possession, you will develop the property, you will construct, you will not allow that fellow inside, you will do whatever you can appoint any architect you want. So full rights are only with the developer and therefore it is not a joint venture. Therefore they said you are a service provider. And he is a consumer. Then the developer argued saying that, okay, there is no consideration flowing from him to me. Then the Supreme Court said, the undivided share of land to the extent of 40% that he gives up is the consideration for the 60% of the construction that you carry out. He reduces his ownership in land, he dilutes his ownership in land to get some apartments. Therefore, that ownership scales down by a certain percentage. That is the consideration. Now, my question to you, if as per Supreme Court, that is the consideration, why should you compare a rate with the new customer? If Supreme Court has said that the value of undivided share of land is the consideration for the construction to be carried out by the developer for the landowner, why should I break my head on the assumption that consideration is not ascertainable and try to compare the price at which a new apartment is sold? The value of land can be valuable consideration. Even for capital gains purpose, we use that. Therefore, the value of land can be consideration, and on that somebody can pay 18% GST. That is one option. Then there is an interesting option in service tax. In service tax, one of the developers argued saying, sir, I have constructed 100 apartments. 40 is for me to market to the customer. 60 I have built for the owner. He is not paying any money for construction. I have spent from my pocket. Where will I recover this money? Only from my other 40 customers. Therefore, when I fix the price for the 40 apartments, I take into account the cost incurred for the entire 100. So the cost incurred for the owner share is also factored in my cost construction statement while I arrive at the selling price of the 40 apartments. On the 40 apartments, I am paying service tax. Therefore, I need not pay service tax again on whatever I construct for the owner because I've already paid. This argument was accepted by the Hyderabad bench of the tribunal in a case law called as Vasanta Greens. That principle is equally relevant for GST because in GST also, when I pay GST on the 40 apartments, I fix the price by taking into account all my costs, which include the cost incurred for the construction for the owners, and therefore technically I paid GST even on that construction. It's a good argument to take. No, sir, both are arguments. I don't want arguments. I want to go in a simpler route. Then take the comparative rate, apply the comparative rate as per the notification, and charge GST on the owners. This is as far as area share is concerned. Then comes the developer and the owner. The developer, the owner is also in business, or owner knows a little bit of accounting, and the owner says, why not we do something? You are going to construct and you will take 2-3 years time. I am quite old. I don't know when I'll see the flats. We'll do one thing. We will sign a joint development agreement. But I don't want flats. You give me money. Every time you sell one flat, out of the sale price, you give me 60%. 40% you keep. So every apartment the developer sells, he pays full rate of GST. Since he pays full rate of GST, then what happens is that when he gives the money back to the owner, there is no service provided by the developer to the owner. So in the absence of any kind of service being provided or supplied by the developer to the owner, there cannot be a GST, the revenue share model. So there is a new model called as revenue share model, where the builder develops, sells apartments to customers. On the entire 100 apartments, developer will pay GST and charge it from the customer. As and when he realizes money, he will share 60% with the owner. So owner receives cash or money. Then there is a third dimension. The third dimension is the notification says, sir, owner has given something called as development rights. This development right, according to us, is a supply. And according to us, because it is a supply, we will exempt it. We will exempt it till the point of time when the developer gets what is called as a completion certificate. The day when he gets the completion certificate, the developer has to look at this apartment. Okay, I've got completion certificate. Out of this 100 apartments, how much I have sold? How much is unsold? So based on the unsold area to the total area, proportionately, this developer is supposed to pay GST on development rights under reverse charge mechanism. And since it's under 5% category, no ITC also. So here, pausing for a moment, let us understand what is development right. This 85-year-old man, when he entered into a joint development agreement, he gives the permission to the developer to enter the property. So in that sense, he gives him a license. He gives him a right to develop the property. And he gives him the power to sell undivided share of land to the extent of 40%. So he gets 60 apartments, but for getting the 60 apartments, he has given 3 items. One, he has given you permission to enter. 2, he has allowed you to develop. 3, he has also allowed you to sell land. But even though 3 items are there, all 3 are parcel and understood as development rights by the notification and assume that it is taxable and valued. So my first point is, development rights are incapable of valuation in terms of square feet or in terms of comparison as what the notification suggests. Second, even better argument, what is development rights? Right to develop land is nothing but immovable property. Development rights are considered as immovable property because any benefits arising out of land is also land. Fishing rights are immovable property. There are judgments which said that development rights are immovable property. You had Cheddar housing, and you also have the very recent DLF tribunal judgment, Chandigarh bench, in the context of service tax, where in service tax, when the department tried to tax development rights, the Chandigarh bench of the tribunal said that development rights are nothing but immovable property, and there cannot be a service tax levy on immovable property. So once it is development rights and it is treated as immovable property, it walks out of GST automatically. So how can there be a notification that says development rights are exempted and they are taxable after a cut-off date? You can exempt only something which you can tax. GST is only on goods and services, not yet on immobile property. If it is already on immobile property, there is no necessity for our former finance minister to keep on saying we have to bring real estate into GST. Stamp duty is being levied separately for immobile property transactions. State government levies the entire stamp duty and registration fee. So immobile property is yet to come into GST. Real estate is yet to come into GST. Petroleum product is yet to come into GST. Alcohol is yet to come into GST. These are all settled positions. So if something is not in GST, can you exempt it? It is like income tax law saying that GST is not payable on income. They won't say that. Why would they say that? Can there be an exemption notification saying GST is not applicable under section 10? Or it is like GST law saying that income is not subject to GST. You don't have jurisdiction to talk about a subject. You cannot exempt it. The power to exempt indicates a power to levy. Only if you have the power to levy, you have the power to exempt. So the notification itself is superfluous when it says that development rights are exempted up to a cutoff date, and after the cutoff date it becomes taxable. So first principle, development rights are immobile property. Second principle, development rights are incapable of valuation. If the development rights are incapable of valuation, then there is no mechanism for computation. If computation mechanism fails, the levy itself fails. This is a decision of the Supreme Court in Srinivasa City's case. Then I'll give you one more dimension. As per the notification, you are supposed to pay RCM, reverse charge mechanism, on development rights when you get CC based on unsold stock. So you presume it's a supply first. Let's go back to section 7.1. Supply of goods or services or both in the course or furtherance of business. When an 85-year-old man enters into a joint development agreement and hands over his ancestral property to a developer, can you say that he is engaged in business? He is not engaged in business. If in his hands it is not a supply, can it become a supply under RCM? Only if it is a supply, RCM can apply. So when a landowner, forget the 85-year-old man, any other landowner, when he enters into a joint development agreement, he is not in business. There is not an activity of business. If there is an activity of business, then everybody will call it as business income and pay a tax accordingly. They all pay capital gains. In fact, there are special provisions in income tax law which postpones your capital gains to the date in which allotment is done or a CC is issued. 45(2)(a). So it is recognized as capital gains because it is a transfer of a capital asset. It is not an activity of business. Therefore, if it is not business, it is not a supply. If it is not a supply, how can you put RCM? So levying RCM under development rights is questionable on the ground that it is not a supply in the hands of the supplier. Levying GST on development rights is questionable on the ground that development rights are by itself immobile property. And there is no mechanism for valuation of development rights, and therefore the levy fails. These are some of the points as far as development rights are concerned. Then there is a new theory. Sir, this development rights has come under reverse charge mechanism from 1419. That means prior to that, means after 1419 RCM comes, developer pays. If developer doesn't pay, it is his problem. Therefore, landowner keeps quiet. But prior to that, landowner should pay GST on development rights. Again, going back to the same point. If development rights is not a supply, if landowner is not engaged in the business, where is the question of landowner being liable to pay GST on development rights? Therefore, one simple area of real estate has got so many complexities in terms of joint venture. So first point as far as joint development agreements are concerned is what you do called as construction for the owner. Under construction for the owner, you may have an area share model or a revenue share model. In an area share model, we discuss the tax implications. In a revenue share model, there is no tax implication because only money is going and there's no corresponding supply. As part and parcel of joint development agreement, there is a development right that is contemplated. And we are talking about how the development rights are dealt with through the notification and how legally we can look at that. So this is the second issue as far as real estate is concerned. Third interesting point. 17(5) of the CGST Act has got a list of categories on which I cannot claim input tax credit. One of the categories in 17(5) talks about construction. Goods and services used for construction of immovable property, or goods or services for works contract, or works contract services used for construction of immovable property. I'll give two examples. Plain reading of 17(5), then we'll go to interpretation of 17(5). Plain reading of 17(5), what are they saying? I'm a developer. My business is to construct apartments and sell. Therefore, when I engage a works contractor or when I buy cement and steel for constructing these apartments, 17(5) does not prohibit me in any manner. I'm eligible for input tax credit. But of course, if I'm going by 5/19 and I go by a strict interpretation, I will get stuck with the ITC. But 17(5) we are discussing, not 5/19. I mean 3/19, sorry. So under 17(5), the question is whether a developer can claim input tax credit of the GST charged by the cement supplier, steel supplier, or contractor. Answer is yes. Then what does 17(5) say? Who cannot claim? As per 17(5), I'm a manufacturer of chemicals or I'm a manufacturer of rubber components. I decide to put up a massive new factory, spend a lot of money on contractors, put up a huge building, warehouses, etc. All these I create as infrastructure. All these are assets, also known as immovable property. Then 17(5) says, no, you cannot claim ITC. Then my argument would be, sir, it is unfair. I am putting up this rubber component factory only to manufacture rubber components, and on the rubber components I'm going to pay GST. Therefore, what is wrong in taking credit on the works contract and the cement and steel? Then somebody will say, no, read 17(5), you cannot get. So definitely section creates a bar. Take another case. Somebody puts up a shopping center. Of course, now all shops are closed and the retailers are struggling. But let us imagine a situation where things are good, business is good. Somebody puts up a shopping center. Now, why does he put up a shopping center? He's going to convert them into 100 shops, lease out 100 shops to 100 shop owners, get rent. On the rent, you will pay GST, commercial rentals. Now, the shopping complex owner asks a fair question. Sir, I am paying GST on my rent. I cannot get rent unless I build this complex. I cannot build this complex unless I engage construction and contractors. Why can't I not take the GST credit? So the question is 17(5) fair? Is 17(5) correct? When the overall philosophy of GST was to eliminate cascading effect of duty. Please remember, constitutional amendment was brought in only to prevent cascading effect of tax, because the old system was giving cascading effect. So one company went to Orissa High Court, Safari Retreats. That company went to Orissa High Court and said 17(5) is wrong, unconstitutional. You cannot deny me construction credit because I'm a mall owner. As a mall owner, I'm letting out all the units. On the rentals, I'm paying GST. What is wrong in getting ITC? Orissa High Court said, okay, we will not strike down the section. We will read down the section and say that it defeats the objective of GST if you deny ITC. Therefore, he can take credit. So even though section 17(5) said that you cannot take construction for immovable property, Orissa High Court read down the section. Courts have the power to either strike down a section or read down a section. Reading down means they will read down in such a manner to make it workable. So they read down the section and said, we are reading in such a manner that the philosophy of ITC is lost. Philosophy of GST is lost unless you give input tax credit. Therefore, they said eligible. So now everybody is in a dilemma because matter is now in Supreme Court. Should I follow Orissa High Court judgment or should I not follow Orissa High Court judgment? If I follow Orissa High Court judgment, I will take ITC. If I don't follow Orissa High Court judgment, it is all cost. Very easy decision. Except the developer comes and asks the chartered accountant, sir, what happens if Supreme Court says Orissa High Court is correct? Can I claim ITC then? Then auditor will say, sorry sir, time barred. Please look at section 16(4). Your time limit is over. You should have claimed by October. But you only said don't claim that time. That is because you are worried about the judgment. So the professional and the client are in extensive debates as to whether to claim or not to claim. If you claim and the Supreme Court says Orissa High Court is wrong, then the revenue will come back to you and say, even if you claim, they will ask you a question. But they'll come back to you and say why you have claimed. If you don't claim and Supreme Court says Orissa High Court was correct, then you missed the bus because you've not claimed. So what many businesses are doing is they're taking some kind of a limited risk by saying, I will claim, but I'll see whether I can not utilize this. Is it possible? Of course, subject to portal allowing you. If I am able to say that I'm not going to utilize it, at least I will say later on that I can always reverse it. Assuming you utilize it also, then the question comes whether interest can come or not. And there are a lot of debates on interest applicability, which is pending before courts. But the point I'm trying to say is, having gone into GST, having said that everything is taxable on one side, you should give ITC for everything on the left side. There is no point in creating islands and saying no ITC for this, no ITC for that. If you're using food, no ITC. If you're using that, no ITC. Why? You're right in saying, yes, you're having exempt transaction, therefore I will not give you ITC. That is a different point. But why should you deny ITC for something which is ultimately taxable? So that is the another dimension as far as construction is concerned. The last point for discussion for today. I am getting completion certificate. Now, why do I get completion certificate? I have done a lot of fast work. Whatever money I have put into the project is complete. No customer. Project is complete. CC obtained, let us say today, on July 4th. You read the notification, it says, as soon as you get the CC, all the formulas come into play. You lose substantial amount of input tax credit. It goes from date of inception. Now, if I am a developer, and if I'm developing 100 apartments, I booked 30 apartments, got 5, 15%, 10%, 20%, some money is coming in. Then I get CC. Then I get customers. Now, you can't ask me to reverse ITC for the entire history because those 30% of those fellows who have booked already will continue to pay me money on which I have to pay GST even though CC has come. CC will protect only new customers. CC will not protect the old customers. So all customers who had booked apartments with me, who had got into agreements with me before the CC date, continue to be liable. I am still liable to pay GST on them. Only for a fresh customer who gives me 1 rupee after a CC comes, I won't charge him GST. Therefore, the question is, why should you reverse your entire accumulated input tax credit, your past credit, what all your credit, whether a notification can deny that benefit? Because that ITC is meant for that customer also. Second, what is CC? Project is complete. CC is not an exempt supply. Because exempt supply means supply. There is no supply. If it is immovable property, it is not even a supply. If it is not even a supply, how can it be an exempt supply? Third, how do you value this? Of course, the notification says the area calculation, etc. But in reality, when I sell a unit after CC, then I'm getting some money. So in the month in which I sell units after CC, I'm getting exempt consideration or non-taxable consideration. I'm also getting consideration from those old fellows on which I'm paying GST. That month ITC proportionately, if I reverse, should be a fair construction. Whether I should reverse all my ITC on getting the CC, pre-service tax in the pre-GST regime, service tax, there is already a judgment called as ATIC Industries, ATIC Industries, where it has been clearly held that CC is not an exempt service. Merely getting a CC does not mean you have to reverse your send back. That logic would equally apply even for GST. So a developer today is stuck in many ways. He's stuck in many ways because he's got a huge set of inventory. And as soon as he gets the CC, if the tax authorities come and say you have to reverse so much of input tax credit, you have already utilized the input tax credit for 30% of customers, and therefore he must find cash to pay. And he does not have cash. If he has cash, he may as well sell the buy. He may find buyers. He's not able to find buyers. He's struggling. So the entire notification pertaining to real estate requires a review. My suggestion would be, number one, don't keep 5% as a mandatory option. Bring another option is either 8% or 10% with ITC. Second, don't bother taxing development rates. Leave them. There's no necessity to tax development rates. Make it clear as to how you want to tax construction for landowner. Call it works contract. Make it clear so that at least for that portion he gets the ITC. And make it absolutely clear that even after CC, there is no question of reversal of ITC unless you get revenue from sale of units after CC, in which case that one's proportionate ITC alone you may have to reverse. If these things are done, it would give huge relief for real estate sector, which is already struggling because of their past market conditions and COVID related market conditions. All of you are aware that COVID related has impacted real estate big time. Today, if you take a commercial project, I don't know about how outskirts of Madurai is, but in Chennai outskirts, you will see that, or Chennai places where major IT companies are located or bigger companies are located, we'll have 12 floors, fully air conditioned, all people working there. And every day 100 buses will go there. Now, thanks to COVID, everybody is working from home. Now the business entity is also looking at, why do I need 12 floors? 3 floors are more than enough. And the new system for buses will be different. If I needed 100 buses to bring that much of employees, in post-COVID, I'll need 200 buses because you have the seating arrangement. No? Gap must be there, social distancing. Bus, no distance, but inside bus distancing. So I'll have to maintain so much of distancing, therefore no number of buses, more number of employee cost, etc. Why bring all those people here? You stay at home and work. Don't have to come here. I will give 7 floors. So suddenly, commercial property is no longer in demand. Suddenly there will be a oversupply of commercial property. So real estate could be in trouble. To take residential apartments, a lot of money has to be put into apartments now, and it's not easy to build the market. But there will be good apartments available, good markets available, good deals will come through. But this is the time when inventory will get liquidated. So when inventory is getting liquidated slowly but surely, this is not the time where you want huge GST on these transactions. So government should seriously look at this transaction and look at it from a different perspective, because this is the biggest employer. Real estate industry is the biggest employer. So some kind of effective tax breaks. No CC, no GST is a simple solution, but there are other consequences in terms of development rates and ITs. It has to be an overall package which covers all these aspects. And you also have to get rid of your income tax law, which talks about saying that if you have inventory, you have to pay notional rent. Why have a notional rent and don't have customers at all? So all those things will have to change if you need to look at providing some kind of solutions as far as real estate is concerned. So these are a bunch of thoughts which I had in going through the presentation, because there were some technical challenges. I thought this is better that I speak in my own style as to what those aspects of issues are there. I'm sure people have absorbed it better. And anyway, the PPT will be available for sharing. They can always refer back to my PPT or notes if they have some clarity. And now we can open up the chat box so that whoever has any questions on what I spoke or anything else related to real estate, I'll be glad to answer.
Yes, sir. Yes, sir. We have received the query, sir. Shall I read the question, sir? Or that will be convenient for you? Shall I read it? Yeah. 1 second, sir. Yes. When a vast land of about 1 acre is developed into plots by laying roads, drainage outlets, street lights, etc., what will be the sale of land? Will the sale of land attract GST? Shall I repeat it, sir?
I understood. See, this is because of that unnecessary confusion of the Karnataka AAR in the case of MARQ. Somebody had got into a development agreement for layout, plots, etc., and they are ruled that there is a supply. So let's be very clear. 1 acre of land, whether you sell as 1 acre or whether you sell as layouts or whether you sell as plots, is still land. Therefore, if you sell land either as 1 acre of land or beautifully defined into plots with wonderful lights and fountains and gardens and compound wall and lights and water supply, etc., is still land. Land is not subject to GST. Therefore, when you sell immovable property, there is no question of GST. Now, where this problem comes? The problem comes because if you sell land, you have to register under the Stamp and Registration Law. Under the Registration Act, any sale of an immovable property for more than 100 rupees, it is mandatory registration. So when you register a conveyance, there is a stamp duty payable on that value. 11% effectively it will come. Therefore, many people think that I want to save some money on that. So they will say, I will put one value for sale of land and then have a separate agreement for development charges. Now, by doing this, what happens is that you're unnecessarily opening up a Pandora's box, because the development charges will have to be interpreted as a supply of service, or it has to be interpreted as incidental to sale of land. So either way, you get into a issue. Then there is a third dimension to it. Third dimension to it is that somebody had given you power of attorney to sell these plots of land, and you paid the money upfront, and then you sell this at the market rates, and then you keep that money. In any event, you are still selling land. Whether through the power of attorney or without the power of attorney, the sale of land happens, and therefore the sale of immovable property. Immovable property is not liable to GST.
Next question, sir. When a developer opts to pay tax at 18% on construction costs and register the land separately, whether department can deny ITC saying it is not eligible as from.
Your voice broke, Ma. Can you repeat the question?
Should I repeat, sir?
Yeah, your voice broke last.
When a developer opts to, sorry, sir. When a developer opts to pay tax at 18 on construction, department can saying it is not eligible as from 1/4/2019. The rate is only 5% without ITC.
That is what I explained by saying that the 5% rate prescribed through notification 3/2019 is not binding. Why it is not binding? Because it is not only a rate of tax notification, it is also an exemption notification. The exemption is in the form of a concessional rate. So instead of 18, it is at 5. So an exemption can be at a lower value or a lower rate. If it is an exemption and it is a pure exemption without any condition, then I have no choice. I have to follow it. But if it is an exemption with 4 or 5 conditions, it becomes conditional exemption. Under 11 itself, it is very clearly said, only if it is an absolute exemption, assessee is bound to follow it. If it is a conditional exemption, assessee can say, I don't want the benefit of the conditional exemption. Or even if he violates one of the conditions, let us assume he takes input tax credit. That means he violates the condition. If he violates the condition, what happens? You are no longer eligible for 5%. Then what is the rate? 18%. So effectively, you can still get into the 18% route and still enjoy the ITs. Yes, please.
Yes, sir. One second. Yes, sir. Another question. In Tamil Nadu, land is registered separately by paying stamp duty. Whether value of land needs to be included while applying 5%. In Tamil Nadu, there are a lot of small builders who construct residential building on land owned by the customer. Whether in such a case, 18% can be adopted instead of 5% because he usually buys from unregistered persons. Whether, yes, sir.
Understood the question. Let me take the second question. That's the easier question. When your customer owns the land, you are a contractor. You're not a developer. I own a land. அந்த காலத்துல மேஸ்திரி கூப்பிட்டு கட்டுற மாதிரி தான். ஒரு பிளாட் வாங்கிட்டு ஒரு இன்ஜினியர் மேஸ்திரி வச்சுட்டு you construct a small house. Only difference is that it's a bigger land, bigger construction. So customer owns land and you construct on that. You're nothing but a contractor. If you're nothing but a contractor, you are in construction service 18% with ITC fully. Once you're under 18% with ITC fully, whether you buy from registered person or unregistered person does not matter. Whether 80%, 20% registration, unregistration does not matter. You can buy from anybody. You can buy from unregistered persons also. But unregistered person will not charge you GST. Because you may have a rate price advantage, but you may not have an ITC significantly available. That is as far as the second question is concerned. First question is concerned. Yes, I am registering land separately. I am registering construction agreement separately. There is separate value for land, separate value for construction. If I have opted for this 3/2019 and I voluntarily gone into that 5% category, then I have no choice. I have to take X plus Y total value. On that, I apply 5%, unless I fight it and say land value should be actual land value and not the 1/3 value. But that cannot be a very big difference if you look at the reality. The reality is that land value will be higher only in cities, and that too very, very so-called posh areas. Posh areas doesn't mean that it may be very livable. Posh area would only mean the value is high or the price is high. You may not have the best of air or nature. So if the price is extremely high, land is extremely high, then it is worthwhile to explore that land is a separate deal, a separate transaction. Construction is a separate transaction. But otherwise, if you are looking at a transaction where the land and construction values more or less, in the range of 2/3 towards construction and 1/3 towards land, then the 1/3 valuation is adequate enough.
Next question. Whether sale of plots with amenities is liable to GST. Recently, AAR of Gujarat held it is liable to GST, quoting NARNI, NARNE, Construction Private Limited. Please give your views, sir. Plots with amenities.
My views on AAR is well known. I've spoken enough in different seminars. Let's understand AAR. Authority for advance ruling comprising of 2 sitting officers from the department. How is it different from an assessment officer, assessment order? Today you go to an assessing officer and he passes an assessment order. Only you and I will know about it. The assessing officer will know about it. You as an auditor will know, a professional will know about it. The client will know about it. Management will know about it. Newspapers will never know. Media will never know. It is like an assessment order. But unfortunately, AAR gets maximum publicity. Why? Because again, professionals. All of us are in WhatsApp. All of us are in emails. All of us share everything. And our friends also include people from the media, journalists, etc. It is very difficult for a media personality to make a fine distinction between a Supreme Court decision, which is binding precedent, vis-a-vis an AAR ruling, which is binding only on the applicant. If Mr. Mohan Sundaram has sought an advance ruling, it is binding only on Mr. Mohan Sundaram. It is not binding on Vaitheeswaran or Abhinaya. It is not binding on anybody else. But first page newspaper, you read it. Then what happens? There is a fear in the businessman. Oh my God, something is taxable, something has happened. Had it been Supreme Court, yes, I fully agree. You have no choice, it's the law of the land. So what do you do in such circumstances? One, don't panic. ARs are not binding. So it may happen in Gujarat, it may happen in Karnataka. Read it for academic interest. But don't panic based on that. You're a professional. Independently apply your mind. Independently read the section. Independently read the notification. Independently see the concept and tell your client, look, they may have said like that, I use this. Don't use AR in your opinions, because if you start using that, you will start depending on it. And 80% of the ARs goes against SSC. So you will still have client who says, sir, என்ன சொன்னாலும் taxable சொல்றீங்க sir. So client may get upset with you, because that is the eventuality if you ultimately enter into. Second, what happens in AAR? You go on appeal to AAR, then you go to High Court writ. This is the one route. But there is a negative side to this. This publicity creates fear, as I said, one reason. The publicity may also create litigation, because another assessing officer in another circle might think, maybe Gujarat AR is right. I never thought like that. Let me issue show cause on this. So there is a possibility of litigation. So what would have normally happened as litigation through assessment seems to be fast tracked by ARs. Now coming to the merits of the AR, since the gentleman asked me the question. When I sell a plot of land, whether it is plotted or potted with a lot of garden pots, etc., it is still land. It is still sale of immobile property. Immobile property sale cannot be subjected to GST, period.
The next question, sale of covered car park or open car park area is liable to GST. That is the question.
This is a little bit tricky, because Supreme Court has said you cannot sell car parks. That is a judgment of the Supreme Court. It says that you cannot sell car parks, whether covered or open, etc. But in reality, people allot car parks just to prevent fights later. Most of the reasons developers allot the A1, A2, B1, B2, etc. to prevent our car owners to stop them from fighting at a later point of time. Now, today what is happening is that developers don't break their heads, because they know that this is a tricky issue. So one thing safely, they'll include all the value in the construction consideration. They may itemize it as car park or open car park, etc. But in reality, from a GST return perspective, they take it as a total value. They take it as a total value, then they pay GST on that. I don't think you can escape GST on that. If you're under the 5% category, anyway, it will get captured in the value.
Next question, sir. Developing a big piece of land of say more than 2 acres into house plots and selling them just as vacant plots, whether RERA is applicable?
RERA is applicable if it is beyond a certain square meter. If I remember right, it is 500 square meter. I need to recheck it, but otherwise RERA would apply for even promoters. 2 acres, definitely it will come. Therefore, if you are promoting plots, you should register yourself as a developer promoter under RERA, and you have to file certain forms with RERA indicating where your plots are, where the GPS location is, what are the amenities which you are going to provide, what are the agreements you are going to enter into, by what time you will finish the project, what are your plans, approvals for layout, etc. Everything has to be transparent. Therefore, anybody can visit the website and find out whether this person is genuine, has he got approved layout, etc., etc. Without doing any of these things, you cannot even collect advance from the customer. Without doing any of these things, you cannot advertise for sale of plots. So RERA will apply, and you will have to get into this compliance. It is not a very complex thing. It is quite simple. RERA is quite transparent and very effective, especially in Tamil Nadu.
Let me check any more questions. Yes, sir. All the questions.
Good.
Only that's all, sir. All the queries has been you have answered.
Very good.
Yes, sir. I think. Sir, if you want to share any more points, still we have can take for 15 more minutes. If you wish, you can share any more points, sir.
So one is may not be points as such, but let me give a little bit of hope for professionals who are worried as to where the future is. I know things are quite bad. And, clients are in trouble. And of course, as auditors, you've been doing your audit virtual, little bit of virtual, non-virtual, etc. but please don't take any risk. It's just not advisable. Yes, there are deadlines, there are pressures, but wherever possible, try to shift into virtual mode instead of physical mode. Going forward, as professionals, we'll have everybody has to accept this technology. Today, people have easily accepted. Today, the very fact that the institute is organizing so many webinars, and these webinars are quite popular. That's an indication. In fact, there is an overdose of webinars also. Everybody has got some kind of webinar hangover, because you keep sitting over multiple webinars and you attend so many webinars, you lose track of it. But,
anywhere in India, sir. Attending webinars anywhere in India. So that's the comfort.
Anywhere in India. And as a professional, my pressures are even more interesting, because before this COVID, for example, July 4th, I had to come to Madurai. To speak to you. One day morning, I had come there and then came back in the evening. I would have got a call from Delhi branch. I would have got a call from Ahmedabad branch saying, "Sir, can you allot time for us on July 4th?" I would have probably said, "No, madam, no, sir, I am in Madurai that day. I've already committed. I cannot come. Sorry, sir. Next, can you give one date?" Now that is not possible. If I say Madurai July 4th, they ask what time. So that is in the evening. Okay, can you speak to us in the morning? So now it's even more pressure for me, because it's very difficult to say that I'm in this city, therefore I cannot come. In a way, it is also, I'm trying to ration my speaking assignments to ensure that I don't lose my own sanity. But at the same time, audience also should not be bored. So best way for youngsters would be, if you're in practice, this is the best opportunity for you to learn. You will never ever get this opportunity, because in this COVID forced circumstance, you are finding that so much of valuable lectures are available in YouTube and other domains, including CA websites. Therefore, you find that so much of good speakers, good senior 40 years, 50 years of practice, they have shared so much of their wisdom and experience and knowledge. You will never get it like this. Maybe you will go through a journey with your senior, but now you get an opportunity. So, if you are a youngster and willing to come up in profession, my advice to you is cut down a little bit of, I'm not saying eliminate Netflix, I'm not saying eliminate Amazon Prime. Keep that also, keep this also. Balance it in such a manner that you're able to use this time effectively. And stay safe, stay home. Thanks.
Yes. So one member is specifically asking when you will be writing a book in GST. Just now I got this comment.
Yes, I've been asked to write a book, and see, one is digital economy. I wrote because I was anticipating this taxation digital economy, and then that is doing very well thanks to God and well-wishers and readers. It's quite it's hit the bestseller list for Tax Sutra as well as Amazon for some time. And my next project is a short-term project. Once I finish that, I'm going to start a GST book. So 2020, you will definitely see a GST book.
Thank you, sir. Thank you. Yes, sir. Now I request Mohan Sundaram, sir, Secretary, to propose vote of thanks.
Respected Chairperson, CAAK Abhinay, respected Guest of Honor, SARC Chairman, TC Jain, respected Speaker, learned Advocate Vaitheeswaran sir, senior members, fellow members, and junior members, on behalf of Management Committee of Madurai Branch, we thank the Speaker, learned Vaitheeswaran sir, who accept our invitation and deliver informative presentation on works contract and construction services related issues in GST. Sir, it is very useful to the members, sir, and also you are interested to share your expert knowledge to the benefit of members. Once again, thank you, sir.
Thank you very much.
And we thank to the speakers of previous 5 sessions, CA Jatin Christopher, CAM Selva Kumar, CAM Venkatramani, CA G Saravana Kumar, CA J Balasubramanian sir, for their dedicated presentation on GST subject. Thanks to all the members who view this program. Thank you, sir.
Thank you, sir. Thank you.
Thank you.